はい。では、そろそろ時間になりましたので、始めてもよろしいでしょうか。おそらくですね、まだもう少し、お見えになる方いらっしゃるかなと思うんですけれども、時間も限られておりますので、始めたいと思います。本日はですね、インパクト志向金融宣言主催のイベント、ESG 投資から見たインパクト投資、その現在地と今後の展望にお越しくださいまして、誠にありがとうございます。今日はですね、インパクト志向金融宣言の署名機関でない方もですね、お越しになっていらっしゃるということで、本当に簡単にご紹介をいたします。インパクト志向金融宣言というのは、インパクトファイナンスを推進する意図を持つ金融機関が集まりまして、プラットフォームを作り、2021年11月に発足をしております。その時ですね、21期間ということだったんですが、現在、10月時点、本日ですね、で67期間、約3倍ですね、増えているという形で、活動を行ってきております。改めまして、私は事務局を務めております、社会変革推進財団の小笠原です。本日はモデレーター司会を務めますので、どうぞよろしくお願いいたします。さて、世界の ESG 投資の割合は、運用資産残高において全体の3分の1を超えたというような報道がですね、最近よくなされているかなというふうに思います。さらにそのサステナブルファイナンスという文脈において、アウトカムですとか、インパクトというものの重要性というのも脚光を浴びるようになってきております。意図を持つ、インテンションがある、そういったですね、そしてポジティブで測定可能な、インパクトの創出を目指していくというインパクトファイナンスは、今後このサステナブルファイナンスの中で、どのような成長を遂げていくのでしょうか。本日のセミナーではですね、この PR インパーソンが東京で行われるということを契機にですね、海外からESG 投資家の方、それからインパクト投資家の方、なんと5名もですね、来てくださいました。最初、皆さんPRI の方もございますし、それから、インパクト関係ですと、ちょうど今、GSG と GIN がですね、ヨーロッパで行われておりますので、インパクト関係の方、皆さんお忙しいのかなということで、このセミナーを開けるんだろうかと、ちょっと危ぶんだんですけれども、非常に素晴らしいゲストにですね、来ていただくことができました。インパクト投資の現在地と今後、どのような景色が見えていくのを考えていきたいと思っております。Thank you very much. My name is Yuka Ogasawara, Secretariat of Japan Impact-Driven Financing Initiative, which is a platform of Japanese financial institutions aiming to drive impact financing movement mainly in Japan. Today, the seminar titled Impact Investing from the Perspective of ESG Investing. Will these two merge into one? Organized by our initiative, we have such a luxury of having 5 guests from literally around the world: Singapore, Malta, Connecticut, London, and Amsterdam. Okay. 基本的には本日ですね、英語で進行させていただきますが、最後の、クエスチョン&アンサーのところでですね、必要に応じて日本語訳を行いますので、日本語でもご自由に、質問の方を投げていただければと思います。So, in the introduction time, let's just get into the discussion. So first, we'd like to introduce each speaker. We have players engaged in Africa, Southeast Asia, and of course, globally.And not only we have both impact investors and ESG investors, but we have players across different asset classes, listed and unlisted equities and fixed income players. Okay, from this end, Albert Alginer, founder and CEO of Mediterranean Capital Partners, and Kiara Boneman, director, Phoenix Capital Group.Maria Elena Drew, Director of Research, Responsible Investing, T. Rowe Price. And Peter Johnson, Co-founder, Co-managing partner, Developing World Market. And Tan Xiaomin, Chief Investment Officer of ABC Impact. Thank you very much for coming all the way to Tokyo.Okay, first of all, could you please introduce yourself and your business one by one from Albert-san?
ありがとう、Yuka-san. Thank you for inviting me. It's a pleasure to be here today with all of you and talk a little bit about what we do and the impact of our work. I think I will start saying that our firm it has two main objectives. The first objective is to deliver returns. At the same time, with the same amount of importance is to deliver impact. And I think that's probably a strong opening statement that I think is extremely relevant for this seminar conference. My name is Albert Alsina. I'm the founder and CEO of Mediterranean Capital Partners. We are a dedicated firm, private equity and listed equities, investing in what we call the development gap. There is a gap between many of the sectors and companies that we invest versus what those sectors and countries should have. And that's where we invest. And our big objective is to ensure that there is a good healthcare services provided in countries that we invest, which we invest in many hospitals, in many clinics, in many pharmaceutical or generics manufacturing, and so on and so forth. And the same thing with many other sectors, education, financial inclusion, financial services, as well as food security, etc. Today, the company employs over 22,000 people across many different companies in Africa. We invest in more than 13 sectors. We have done a number of exits, divestments, being from IPOs to secondaries to strategic sales. And that has also been driven by delivering back to our investors early liquidity. Our returns so far in our third fund are around 21% per annum on a gross IRR basis. And our big focus has been not only delivering those returns, but on top of this, delivering the impact that I'm hoping today we'll be able to discuss here. This is in a nutshell. You can see in the picture a number of countries which are in blue, some others which are in yellow. We invest mainly in the ones in blue, and the ones in yellow, we create platforms of regional players that will have presence not only in those countries, but in some other countries. In total, we invest in around 30 countries in Africa. Sometimes we also invest in Europe, and that's driven by looking for a technology or a product that our companies in Africa can also sell to the consumers that we manage. Maybe just to finish, Yuka, Africa today is 1.2 billion people. By 2050, will be 2.6 billion people. By the end of the century, will be 4.6 billion people. As you can imagine, this is a demographic challenge, as by 2050 will be more than 800 million in a working age population. So at the same time, we see that as a big challenge, but also we see that as a big opportunity for many multinationals and companies that today they are not present in Africa, and we believe we are a great platform to make them, feasible to enter into those markets. And that will be it for Mediterranean Capital Partners. Thank you.
Good afternoon, everyone. Thanks a lot, Yuka-san, for the invitation. It's a pleasure to be here to discuss about impact investing and our perspective from Phoenix Capital. We are an impact investing consultancy firm focused on supporting institutional investors and fund managers with making impact. We started in 2012 in Amsterdam, so we're still based there with global activities. Our activities are mainly of two kinds. On one hand, we offer tailored advisory services to institutional investors to invest in impact funds, and that is mainly sourcing of funds, impact due diligence, and on the other hand, we help asset managers with the impact measurement frameworks. And the other side of the business is really about sharing our market intelligence globally. We do that with publications and global events and data insights. I will share a little bit about what we do in this in introductory slides to give you a sense of what we do. I thought it was important at first to tell you how we construct our universe. I think the foundation of everything we do is really the coverage of the universe of impact funds that we have. We currently have 2,500 funds listed there across asset classes, impact themes, and geographies. And as you can see, we tried to highlight a little bit the spectrum. Not sure if it will be very visible, but we focus on what you sometimes hear is called returns first impact investments or financial first impact investments. Basically, that part of the impact spectrum, as Albert just said, that is focusing on maximizing both returns and a social environmental impact. So it's aligned to the GIN definition, but then narrowed down to only focus on that part, targeting at least market rate returns. And within this universe, we see there are more than 2,500 funds across asset classes. In the next slide, if possible, thank you. And a constant increase throughout the years. It's been really exponential, also during the pandemic, very positive growth. More than 1,000 managers found managing these impact funds, and around $680 billion of assets under management. In the next slide, we see the breakdown in asset classes. Private equity is predominant. It's almost 50% of the total funds that we currently monitor for, I think, in the slides, and then followed by private debt and infrastructure and public equity. Public equity definitely being the fastest growing in the last years, with efforts, for example, of the GIN of defining what is impact investing in this asset class. If we were to look at this picture, though, from AUM perspective, assets under asset management, it looks a little bit different. And that you can see in the next one, private equity is still the first one, but 30%. And then infrastructure and public equity are sort of promoted to second and third place, which is really showing the nature of the underlying assets, which are a bit more sizable, can absorb more capital compared to some of the microfinance funds that we see in the private debt asset class. And just concluding in the last slide, I wanted to give you a sense of the impact themes that we see being targeted the most in the impact investing space. And that's definitely right now are more skewed towards the environmental SDGs. The most popular one and the clear bias is towards SDG 7, energy transition and clean energy, followed by infrastructure and responsible consumption and production. So yeah, that's it for now. I'm glad to be here and looking forward to this discussion.
Thank you. I'm Andrea, right? And thank you very much for inviting us. So for those who aren't familiar with T. Rowe Price, we are an asset manager based in the U.S. that operates all around the world. We have 1.4 trillion of assets under management. And we service clients in 52 countries. And I think what sets us apart from a lot of other asset managers is that we are predominantly managers.
Oh, I turned it on. That would help. Okay. So as I mentioned, so T. Rowe is 1.4 trillion of AUM, and we're predominantly an active manager. If you want to go to the next slide, this just shows how impact fits into the T. Rowe Price landscape, because unlike I think most people on the panel, impact is not the only thing we do. It's one of the newer things that we're doing at T. Rowe Price. And I think we're probably representative of that growth in the public listed equity space that you were showing and public bond space. So at T. Rowe, the majority of our AUM comes from clients who've asked us to deliver a mandate for financial performance. So we call that group this financial only bucket here. So these funds use ESG in order to maximize their performance. if we look at the next three columns here on this slide, it kind of goes up the scale in terms of the objectives that clients are putting on us. And these ESG enhanced, net zero, and impact are all areas where our clients have specifically said to us, we would like you to deliver financial returns as well as specific ESG objectives. So in the impact space, we have launched a series of funds so far. So we have three right now: one global equity impact fund, one US impact equity fund, and one global impact credit fund. And we plan to launch some additional impact funds in the coming years. If you want to jump forward to slide 4. All three of our existing impact funds are pretty broad-based in terms of what they target. We think that one of the advantages that you can get in going into the impact space here is, first off, it opens up the client base. Not all clients, especially a lot of the clients that we service at T. Rowe Price, are able to invest in a private fund. They really need public vehicles, so this gives them that opportunity. It also allows you to have a bit more scale in what you're doing, and better liquidity, as well as a diversified portfolio. So if you could go to slide 4. There. So on this slide, it just shows the area that our impact funds are currently targeting. So we have 3 main pillars: so climate and resource impact, social equity and quality of life, and then sustainable innovation and productivity. Maybe I will leave it there and turn it over to Peter.
Thank you to Yuka-san and each of the sponsors of today's event. It is a pleasure to be here. So, developing world markets, let's call ourselves DWM. We have been originating and managing impactful private assets for 20 years. These assets are typically private debt, sometimes private equity, in financial institutions in developing countries. On page 9, we quickly will give the geographic scope, and you can see that we cover Latin America, Africa, Eurasia, that's say Eastern Europe, Central Asia, the Caucasus, South Asia, and Southeast Asia. In these regions, over 20 years and over $2.5 billion worth of assets, we find that we are able to reach women. We're able to reach women by lending to financial institutions who in turn lend to women who have otherwise no access to financial services. These are women who live in countries or regions and at a poverty level where banks do not want them as customers, or where there are no banks in the first place. So we lend to specialized local financial institutions that you've never heard of, who in turn lend to them. The quality of those financial institutions that you've never heard of is excellent. And so the financial performance of our funds is more than satisfactory for the insurance companies, pension funds, and other institutional investors who fund these investments. What it means is we're able to reach literally millions of women around the developing world in ways that the largest insurance company in Sweden, or the 4th largest insurance company in Germany, or one of the top 5 pension funds in the United States, these are among our investors, would otherwise have no access to, would have no way to reach. That's impact investing, the way we define it. We just switch to, in rapid succession, 3 slides to show how we target and measure reaching SDG number 1, no poverty. It's one of our several highest quality goals, and we have been measuring impact in this category ever since this SDG existed, and actually before. And in rapid succession, on slide 30, slide 33, we've got SDG 5 for gender equity, and SDG 13 for climate action. I'm just giving you a sample of the 3 of the most interesting ways we reach through the financial institutions to the underlying people and companies and smallholder farmers and renewable energy projects and water and sanitation and other areas on the ground that can be reached this way. This is impact investing. When these investments on the ground perform well, the financial institutions perform well, and our investors receive world-class returns. I'll leave it at that.
Hi. Thank you, Yuka-san, and the organizers for the invitation to today's event. My name is Xiao Ming. I'm the Chief Investment Officer at ABC Impact. So for us, we are a relatively new organization compared to the other members of today's panel. We are formed back in 2019, and we are a private equity fund that's dedicated to impact investing based in Singapore. We are looking to back companies that contribute towards solving a social or environmental problem that is relevant to Asia. And we are also seeking market rate financial returns, just like what Albert mentioned previously. If we can go to the slide number 2. So for us, the name ABC stands for Active Economy, Beautiful Society, and Clean Earth. That represents the ideals of the UN 17 SDGs, and that is something that we want to strive towards. We are members of the GIN, we are signatories to the PRI, we are also signatories to the OPIM, and the performance of our organization has been independently verified by Blue Mark, and we pass with flying colors, and we are also a certified B Corp. Next. So for us, we are Singapore headquartered, Asia focused private equity fund dedicated to impact investing. We manage 860 million AUM across 2 funds. Fund 1 is 300 million, and Fund 2, as of first close, was 560 million. We've invested across 7 economies, and we have 22 professionals. Why the focus on Asia? If you look at Asia, it accounts for 60% of the global population, 40% of the GDP. However, the amount of money that is allocated to Asia is minuscule, and here we are trying to make a difference. For us, when we look at impact, we're looking for evidence-based impact across both the social and environmental thematics. On the environmental thematics, we look at climate and water solutions, and this includes things like solar renewables. We look at energy efficiency plays. For example, we have a liquid cooling technology company that helps to cool data centers without the use of air conditioning. The other theme we look to invest in is in the sustainable food and agriculture space. So within this, we are looking at things like alternative proteins, including insect proteins, plant-based proteins. We're also looking at solutions that can help improve the livelihoods of smallholder farmers who are really driving the agriculture space in Asia. In the social impact space, one of our themes is to provide better healthcare and education. Here, we are looking to provide better quality, more affordable, and in cases, just access to these basic services. It could be online education in India, which is one of the investments that we've made. We look at autism. We look at, for example, dental services in underserved markets. The 4th theme that we invest in, which is also in the social space, is in financial and digital inclusion. So here we are really looking at microfinance, microinsurance, and various other ways that can help businesses connect to the digital grid. Next. In terms of our differentiation, we are the largest Asia-focused impact investor. We focus on the early growth stage, and we have the ability to attract meaningful deal flow because of the lack of alternatives in the impact investors space. And we are also able to support our portfolio's growth throughout the different stages. We have a thought-leading IMM system, which is recognized as best in class in the independent verification by Blue Mark. We have a very resilient, impact-driven portfolio. Our impact lens focuses our portfolio construction towards investments which are really driven by strong fundamental needs and underpinned by long-term macroeconomic trends in Asia. And we do see that very strong trend in the last few years, despite the macro situation and COVID disruptions. We also focus on post-deal in value creation, and we take that very seriously. We have an all-Asian team that's based in Singapore and very strong buy-side experience. And we also enjoy a very strong relationship with our core investors, including Temasek Trust, Temasek Pavilion Capital. And we have meaningful access to the portfolio, and we do help our portfolio companies scale across different markets in Asia. Next. So within the 4 years in Fund 1, we have, in terms of realized deal value, 39% IRR. Our portfolio companies grow on an average about 30% CAGR. In terms of impact matrices, we've provided 27 million people with essential services and helped to reduce 1.7 million metric tons of carbon emissions. Next. As impact investors, we also publish impact reports annually. And if you are interested in our IMM methodology, I suggest that you can look at the first impact report, which is the journey to impact, the one on the upper left corner. And if you have further questions, feel free to reach out to us. Thank you.
Thank you very much. Now, we have very variety of players from different world, different areas, and different asset class. Thank you for that. So, the first topic that I'd like to raise is that, upon the current trend in ESG impact investing market. For example, in the United States, there is this strong anti-ESG sentiment coming from somebody is smiling. Or in the EU, there is this EU taxonomy in place. Things are different. Things are changing. So what is your view on current development of ESG investing and impact investing? So will they continue to grow at the same pace? Will they continue to, will stop the growth? And what will also impact some point, like say the anti-impact sentiment at some point or not? I'd like to get your thought on things around this topic. Anybody want to start? Maybe Maria-san, please.
I can start if you'd like me to talk about the anti-ESG sentiment. I'm afraid it's my home country that is really leading the charge on that one. So at T. Rowe, most of our business is in the United States. And if we look across our platform of investment products, they all do some form of ESG, right? So the vast majority of them do ESG integration, which is just maximizing financial performance by evaluating environmental and social factors that could hurt or help your investment. So we view that as just good common sense. Our clients also view that as good common sense. They would expect us to evaluate every factor that could help or hurt our investments, be that factor industrial, macro, or environmental or social. So in our day-to-day interactions with clients, we get no pushback on this. Where you do see, and actually maybe I would also note when we look at the US client base, we do have a growing number of US clients that are interested in adding ESG objectives, so environmental or social objectives, including investing in impact funds. So you do see that trend growing in the US. But it's a smaller part of the market that wants to do that. But going back to some of our mainstream funds, because where you really do see the difference in the US is it's a political discussion, this whole anti-ESG sentiment. And I'm not sure, we were talking before this about the term woke, but I think ESG has become just another word for woke in the US. And so we're really looking at people who have been disenfranchised So unfortunately, in the US, we've had a very big gap in the wealth divide. So the rich are getting richer and the poor are getting poorer. There are a lot of people in either urban areas or rural areas that don't feel that they are getting a fair share. And I think that drives a lot of anti-woke sentiment. And ESG is just, falling right into that same trend. It's just an interchangeable word. And what we have seen, so we have definitive proof on this because lobbyists have talked about it, is that the Republicans, particularly far-right Republicans, have found if they talk about ESG in a negative way, they go up in the polls. So they will continue to talk about ESG in a negative way because it's helping them. And so we should expect this to continue at least through the next election, and I would imagine it's going to go on for some time. We put out an ESG Investing annual report every year. In this year's report, we talked about technology revolutions and the amount of disruption that you see in economies around technological revolutions. And there's a very normal cycle that you can look at through academic research where they show as new technologies start to layer on, you go through a period where more jobs are lost. People get scared about what's coming next. And you really need much wider adoption of those new technologies before the new jobs start to, replace the jobs that are being lost. And also in every previous technological revolution, we've seen that far more new jobs have been created. However, they tend to be created in different industries, sometimes in different regions, and people might not be, perfectly skilled for those. So like, for example, the age of autos in the US drove this huge boom in suburban living. So houses being built and all that. So I think we're going through that type of change in the United States and in many places in the world. And until we start getting further on that other side, the populism is going to continue, likely will continue to reign, and we'll continue to have people being anti-woke. Maybe I'll just say one more thing and then I'll stop and let others speak on it. We do business with, a number of government agencies, and what we find in our day-to-day interaction, especially those that are in the quote-unquote red states, that they understand ESG integration very well. They're happy with what we're doing because we're helping to maximize their financial performance. But when they get to the very top level or their board, they may have politicians on the board. And that's where the words ESG become problematic. But it's really just from a business standpoint, it is very situational when ESG becomes an issue, and it's quite small. So we don't see it from today.
No, Peterson.
So I am also from the same country as Maria Elena, and I'm sorry for our country's contribution to this issue, but I agree completely with Maria Elena's assessment. This is not an issue with investors. American investors have no problem in general with ESG. If anything, the trends suggest they like ESG approaches. It is strictly a political issue, and I personally think that the viability of this particular political issue for those politicians who are using it will perhaps come to an end when some court cases make their way up ultimately to the Supreme Court. Someone will bring a case that says, wait, how can it become illegal to use ESG to assess risks? How can it be illegal to consider risk in my investment portfolio? Clearly, a court will say, no, it cannot be illegal. So the politicians will continue to try to use this as a platform, but I think as an investment issue, this will be resolved in the courts soon.
Thank you very much. So now we have a view from Europe. What about you?
Thank you. It was a good explanation, Marilena and Peter, on this one. I think it's very relevant. I think in Europe we see a very different perspective from that. I think Europe, being a much more multi-country with multiple governments, ESG has been seen in a very positive way. In fact, the latest legislation introduced by regulators, being Article 8 and Article 9, in fact, not impose, but give a framework for investors to be able to report and to measure and to be labeled as an ESG, even I would say even impact investment friendly. And I think that is extremely relevant to say that we have to be careful that not one small trend for a specific thing, it affects all the good things that we do. And we're seeing more and more interest on impact investing. We're seeing more and more importance of not only of the SDGs, but also on the ESG risk measurements, because as you all know, ESG was introduced by the World Bank several decades ago, and the main purpose was to identify those risks on many of the investments done in the developing world. And that it was a way to mitigate those investments in many different aspects, not only environmental, but also social, labor, many different aspects that were present. Today, of course, the thing has evolved, and I'm sure that, Chiara can help us to see how ESG investing is evolving and is probably linking the impact investing to something very clear and measurable, which is on all the SDGs as well as the ESG measurement system that we put in place. Today, investors impose, at least to us, ESG measurements, ESG people, ESG professionals, ESG analysts. It is a must. Why is that? Very clearly, not only because we create impact and positive impact with all the things that we do. We're more a micro investor, that we invest in hospitals, we invest in schooling, we invest in universities, with very concrete things that close the gap of development and particularly in Africa. But more importantly as well, is mitigates the risk whenever you find a liquidity event. Whenever you're going to IPO a company, which we have done several of them, whenever we go and sell our company to a strategic buyer, because as you know, today, the Fortune 500 companies, 50% of their profit comes from developing world markets. So obviously, everybody wants to have access to those 4.6 billion people that will be at the end of the century, not only in Africa, but in many other developing markets, to be able to capture some of that growth. And in order to be able to do a transaction, today the buyer imposes you to have those measurement and corrective actions being implemented into our portfolios. And that it becomes a major value added to the portfolio that we manage. When we sell a company to a potential buyer, or when we IPO the company in the stock market of Cairo or of Casablanca or of Abidjan, today investors will see the good quality of company that you have built through the last 5 years that we were present. And I think that to me is the biggest value that you bring to the next buyer, in order to, and that becomes an imposition to the buyer, saying, well, what is your social policy? What is your labor policy? What is your environmental? What is your climate mitigation policy? What is your CO2 emissions? All of those things become extremely relevant on that liquidity moment, and that is intrinsic to the returns that we deliver to our investors. Just wanted to add that.
Thanks on that. I think that I totally agree with this perspective that it's really demand-driven growth of the market, both on ESG side and the impact investing side. As you've seen before, we've seen impact investing growing exponentially throughout the last years, and we don't have that granularity on the ESG side, but you can see everywhere in the last decade that it's really been a boom of funds on the ESG side, and that came with an evolution of the term, really. As Albert was saying, I think that it started as a risk framework to understand what potential risks that are inherent to a company and taking decisions for maximizing financial performance. And sometimes right now, however, in the ESG investing umbrella, you have multiple strategies that instead also have some ethical considerations within that, including negative screening, including maximizing positive outcomes, adding positive environmental, social objectives. Investors really want to do that, and it sometimes still falls into the ESG investing umbrella rather than impact investing, which is seen as a bit more niche and advanced. And so we have multiple types of strategies falling within different categories, and the regulator then decided to step in, and we have the SFDR regulations and EU taxonomy in Europe that is helping to classify, to understand what is sustainable as per the EU sustainable objectives. And then with the articles that you might have heard from in speaking about in the industry, we have Article 9, 8, and 6, which are basically articles that regulate what type of disclosures are applicable per investment instrument. 6 being just reporting on the risks that you are assessing. 8 when you are promoting some sort of environmental or social objective, and 9 when you have environmental or social objective for the fund. It has come with some challenges because it is a disclosure framework, but it's being used as a label, but not being intended as such. It doesn't have minimum criteria to be classified as an Article 9 or Article 8. So it's already being revised currently by the EU Commission. And I think it is still a positive sign from the industry to use the framework as a labeling system. It shows that there is a lot of need and also of interest to investors to identify which products they want to invest in with a sustainable objective. So definitely for me, it's an indication that the market will grow further. There will be more clarity around the type of instruments, and hopefully with that lock up even more capital.
Thank you very much, Kara-san. Okay, the view from Asia, please.
Sure, I agree with Kara-san. I think we've been following the developments on the EU taxonomy as well. And I think the fear as impact investors or ESG investors is this fear of greenwashing, ESG washing, or impact washing. And I think increasingly asset managers now look towards the labeling that was described earlier. But it also introduces, I would say, a legal obligation for the asset managers to stick to what they promise to investors, whether it's an impact offering or ESG offering. So I think sitting in Singapore, we do see very interesting developments in this space. There is growing interest from allocators based in Singapore, not just the DFIs and foundations, but also mainstream allocators like family offices, sovereign wealth funds, insurance companies, asset managers. In fact, there's a sovereign asset management study in 2022 that showed that over 70% of central banks and sovereign wealth funds increased their use of impact investing over the past 12 months, with most institutions already actively adopting impact investing. Similar trends are also observed in the ESG investing space. And sitting in Singapore, we do have the Monetary Authority of Singapore, MAS, playing a very proactive role. They've introduced various initiatives to encourage better ESG stewardship and taking into consideration international standards such as the TCFDs, ISSB, for example. For example, I think asset managers in Singapore are now mandated to incorporate environmental risk management in their risk management policies and framework. There's also required climate reporting by unlisted companies in line with the ISSB, and this will align Singapore with global standards and one of the first markets in Asia to extend such requirements to privately held companies. There are also initiatives to digitize basic ESG credentials for micro SMEs to allow these companies to transmit verified data and including ESG data to their business partners, and hence strengthening the ability to gain access to global financing and supply chain opportunities. So there's a lot happening, but safe to say, you know, there is growing interest from what we see here in Singapore.
Interesting. Thank you very much for the views from literally around the world. It didn't become a debate. It's just kind of like a one-sided view, but I agree that the trend will increase, and then there seems to be some political discussions in place for some time, but the trend will continue. So my next question is that we have been talking impact investing, ESG investing in parallel, but I want to further discuss the two different topics. Well, ESG investing and impact investing remain complementary while preserving their distinct characteristics, which means those two remain in a two different form of investing, or will they gradually merge into one form of sustainable finance? Some people say impact finance, impact investing is like a beyond ESG. It's a next form of ESG. And others say, no, impact investing is different. It remains in the niche. What's your view of those two types of opinions? Anybody? Oh, maybe lady first.
I can
Kiara-san, please.
continue on what I was saying before. I think I see probably three types. One is really maximizing your financial performance utilizing ESG risk assessment framework. Then you have maximizing positive environmental and social outcomes and avoiding harm without specifically having a defined objective. And then the third one is impact investing, contributing to solutions, addressing a problem. And these three types of investments actually you could also combine. And probably the fact that the first two are called ESG, that's the most confusing part. And assessing ESG risks in the long term, I think that's part of something that's, as you were mentioning, in Singapore will become mandatory. It's something that everyone will want to do, and it can't be illegal. I think to me it's crazy to think about an anti-ESG movement. You want to use as much data as possible to make your investment decisions, right? So not being able to use that it's a paradox, I think. So probably just defining these type of investments will already support, but until that, keeping it separate, I think could be beneficial to really understand what we are trying to do and what's the sustainability profile of an investment instrument, and categorizing it hopefully will also come through regulation.
Thank you very much. So then Peter-san, please.
20 years ago, 2 decades ago, there no one used the term ESG, and no one used the term impact. There was something called socially responsible investing, SRI, existed. It was simple to understand. It was just make sure in your investing that you avoid alcohol and tobacco and landmines and cluster bombs and things like that. That was easy. Then DWM, our firm, we were one of the first people to design products for mainstream institutional investors that were impactful. I'll use today's word, but we didn't know what to call it. We knew it was something different. So we played with a term that we thought would be easy to understand. Socially positive investing, SPI instead of SRI. Okay, that term didn't stick, and I don't know who invented the term impact investing, but impact has not changed. It's just gotten bigger. There are more and more things now, an increasingly diverse number of ways in which you can invest, specifically intentionally targeting something that's good for the world and delivering a proper investment return. I think it's fantastic. But meantime, what's happened to socially responsible investing that kind of got absorbed into ESG as a different construct? and it has its place in the world. It can be applied to the majority of investment assets, but impact with a very narrow, focused, intentional set of criteria cannot. And so I think they have to remain separate, even as impact investing is growing, and so is ESG investing growing.
Right, if I can add on, I want to offer another acronym, ABC, right, which is not related to our fund, but it's also a lens that impact investors look at impact investing. So A is avoid harm, to what Peter just mentioned. 20 years ago, people just invest, avoid alcohol, tobacco, making weapons of mass destruction, etc. So that continues. There's a red line policy in, I would say, almost every firm, right? And then B stands for benefit stakeholders. So this really means that when you run businesses, you want to be responsible corporate citizens. You want to be able to pay a fair wage to your employees. You want to take care of the environment, make sure you are not destroying it. You want to pay your taxes and benefit your customers, suppliers, right? Be a responsible corporate citizen. And C is to contribute towards a solution. And I think that's the active form, which is the type of impact investing that many of us here are practicing. I think in the ESG space, I mean, that's what some of the panelists have mentioned. There are different tones of it. I think my personal view is that this entire area of impact and ESG will continue to grow. There will be perhaps greater overlaps between the different areas, but there is always going to be a difference between a passive form of impact investing versus an active form, which is to really find companies that solves a problem, whether it's in Africa, in Southeast Asia, where there are populations without access to healthcare, or are we trying to find a company that can help address climate change? Yeah, thank you.
Maybe I think a lot's been said on this already, but maybe I'll just throw one more idea into the mix, which would be, for us, impact is very differentiated from the standpoint that the client has given us a dual mandate versus, I guess, the typical ESG integration. It's a single mandate to deliver financial performance. And I think that differentiation is pretty key. And that is why I don't think you're ever going to see 100% convergence. I do also think it's interesting what's happening right now, because the environmental and social data landscape is changing so much. And also technology is enabling people to understand their investments much more than they did in the past. Whereas, I think most people looking back 20 years ago probably just put money into their pension fund and never really looked at it again. Probably the company allocated their fund for them, and that was it. Today, you can see that. I can look mine up on my phone right now and see exactly what I'm invested in, how that's performing. And as we develop this whole data landscape that allows us to measure environmental and social performance, and for impact funds to demonstrate the actual amount of positive impact in terms of greenhouse gas emissions avoided or that type of things that funds are having, I think it's creating a very new, exciting investment landscape.
Interesting point. Thank you.
Thank you. I think we had a good explanation, and I think maybe the only thing which I would probably, I would say, disagree in a very small words is that ESG, it's very different than impact. I think ESG is totally complementary than impact, because what is the issue of impact? What is the issue of impact investing? The biggest issue is, how do you measure it? How do you tell to your investors that you're actually really creating impact? So what it allows us, ESG, allow us to have metrics around that. And even if we started by defining the ESG metrics to ensure that we mitigate the risk, what it is on the positive side is that then you can measure what are the things that you're doing in your portfolio company specifically to make sure that what you have promised to your investor, you're actually delivering. When I look at our ESG rating, for example, and you look at the environmental, we're looking at climate change mitigation, climate change strategy adaptability. We're looking at ecological footprint. We're looking at resources use. We're looking at pollution, and those are very measurable. You can measure how many CO2 you perform. Today, there's lots of companies today that they can help you. It's not easy, it's complicated, but we have one company from France that is helping us to do those measurements of CO2 emissions by company. And all of those measurements is what we can report on a yearly basis to our investors saying, look, we're creating impact, and that's the impact that we create. Linked to that is how do you create impact? And what are the needs of that creation? I think for the likes of Cao Ming Sun and myself, it is easier because we're investing in many developing countries. So in developing countries, you can actually measure what is the gap of development that is required. For example, the number of beds per 1,000 people that are effective in that country. And that will determine that that country doesn't have a good healthcare service. So how to mitigate that development gap is by investing in hospitals, investing in clinics, investing in diagnostic clinics, manufacturing generics, drugs and products, which bring affordable products to that population. And that is the strategy you put in place whenever you're investing through an investing impact lens. But one thing which is also extremely relevant is, I think I said that before, but I think is very important to repeat it, is that you have to do that not at the detriment of our returns. You have to ensure you will not be doing an investment because it does just only creating bets. No, you have to do it on with a profitable or with a returns mindset, because if you do that, that will be sustainable. That will last forever, because it will be linked not only to the returns, but also to the impact. And then just to wrap it up, probably is to say that I cannot imagine an investor which doesn't have a view of creating some sort of an impact. You know, when you think about it, all of us, we are obliged to create a better world. That's why we're here. So I think it has to be some sort of a lens to any sector, to any market, and to any country, that whenever you have an investor, let's think about that. Look, what I'm doing, is it good for the world or not? And I think that's probably a concept that needs to be not only embedded, but needs to be the driving force for impact investing to become much more wider across the investors' base.
Thank you very much. It's been quite interesting and see. It seems that the views are in consensus that those two remain different, and then the categorization between like ABC or risk assessments towards the intentionally making the impact remains in a separate bucket. Since it seems to have a bit of time, I'd like to raise a question around the EU taxonomy. And people, you are already familiar with the EU taxonomy and what's been happening in practice when EU taxonomy has been introduced. You say it's an information disclosure framework, but this is something more labeling, and would it be a good effect to ESG and also impact investing, if you have any view?
Yes, on the disclosure framework, that's about the Sustainable Finance Disclosure Regulation, or SFDR, that you will hear, and the linked articles. And that one is specific regulation applicable to financial instruments. And it is linked to defining sustainable objectives linked to the EU taxonomy. The EU taxonomy came before that, and it's part of a larger set of regulations of the EU Green Deal and objectives. They define sustainable activities within the EU taxonomy for climate mitigation and biodiversity, etc. You are then able to define what are sustainable activities of underlying companies, referring to this taxonomy. So sorry, it's a bit complicated, I think. But basically, depending on which article you fall under for reporting, you will have to disclose a set of metrics related to underlying companies. If you have a sustainable, if you promote sustainable environmental or social environmental social aspects in your funds, then you will have to report these according to which percentage of the fund is aligned to the EU taxonomy. And for Article 9 funds, this is 100%. It's in constant evolvement, also the taxonomy itself, especially the metrics that fall under the social metrics, and so that's something that we keep see evolving, and it's quite difficult for some funds to, especially when they have activities in emerging markets, for example, to comply to that. So yeah, that's at the moment what is being used.
I think the EU taxonomy is a really interesting tool, and in some ways it was an absolute genius move by the EU, but in other ways it's, I guess, in practice right now it's not very usable. So what it is, as Kara just explained, is a catalog of green activities. Now, we as investors are not allowed to estimate EU taxonomy. The company has to report it themselves. And also the EU has 6 environmental pillars, and for each pillar you get a document about that thick detailing each of the activities that fall under, say, reducing greenhouse gas emissions. So say if you're an aluminum company, you need to produce your aluminum under a certain greenhouse gas emitting level. So really only the company itself can identify the percent of their revenue, OPEX or CAPEX, that's aligned to the EU taxonomy. So the reason why this is so genius is because it's a great tool that could marry financial performance with achieving environmental objectives, because not only does it identify how green a company is, but the EU could say, well, I'm going to tax you less if you're involved in this activity than if you're involved in the dirty activity. So for an impact investor, that could give you an even clearer delineation to better financial performance. So that's a great tool. In practice, it's problematic because it's taking so long to roll out. But the other Achilles heel of the EU taxonomy is that it is a rigid catalog provided by a government entity. And I don't mean to besmirch governments and regulators who do a great job at what they're doing, but they're never going to be at the front end of innovation. And if we're looking, to get to net zero by 2050 and reach our climate goals, we need to direct investment dollars towards the front end of innovation. And investors are much more likely to find that than a regulator is, just because of our skill set. So I think the EU taxonomy is a good, it's an excellent tool. And I think of it sort of like as a trust but verify tool. So there's another concept for the SFDR, which is called sustainable investments. And in that one, the asset manager can define what a sustainable investment is. So when the taxonomy is fully up and running, I think that you can have asset managers have a slightly wider definition in their sustainable investments, because they're going to be looking at these innovative technologies. But all of our clients can see how accurate and how pure are we by looking at our alignment to the EU taxonomy. And it will make it much easier for our clients to understand how far off the path is that asset manager. Are we really far from the taxonomy, or just a bit far, and can we explain how we're different?
Thank you. Peter-san.
I like the positive aspects you highlighted, Maria Elena, even as you identify challenges to the EU taxonomy. For a pure impact investment manager such as DWM, I think it's ideal. It answers the question: are we an impact investor or are we an ESG investor? We fit squarely within Article 9. Each of the funds we manage are clearly Article 9, and that clarity extends beyond the EU. I compliment the European system for having designed this. It's now recognized around the world, in the UK, in the US, even here in Japan. It is a clear language to say we manage Article 9 impact funds. Deep green.
Thank you, Peter. If there is something that we do good in Europe, is regulate. You know that we even regulate the size of the apples that you can actually sell in the supermarket. So in regulation, we are the best. That's why I have to admit that. But going to something else that we have not discussed here, but I think it's irrelevant as well. We talk about the trend of being anti-ESG manners, because if someone doesn't like it, they will link themselves to that trend, and we'll talk about it. But there's another trend that is happening in the US I have seen over the last, I would say, probably 2 to 3 years, which is the trend of the big endowments or university endowments that actually imposing impact investing. The students and teachers and communities of those endowments, they're big time, very vocal by social media, but even demonstrations on ensuring that those endowments, they have an element of impact, which it is actually, to me, much more bigger than the ESG anti-sentiment that is mainly driven by the press, by the real actual importance of it. How have you seen that also, not only in the endowments of university, which probably are the most far advancing on impact investing, right? I can see, at least from the States, and how is that being spread through the other investors? I think that's a question as well to see, because I think it's extremely relevant for us, because let's face it, a majority of the LP base is comes from the US, where the majority of investors are theirs, plus, of course, some other pockets like the Middle East or like the Nordics, mainly pension funds and so on and so forth, and some pockets. But how do you see that? I mean, that's, sorry, I shouldn't be asking questions to that, but I thought was very relevant maybe for our US friends here.
I need the question repeated. What's that going to do?
No, the trend of the university endowments on the of pushing for impact is, I think, is bigger and has a bigger impact than the trend of this, ESG
Yeah, so endowments, I think, have always been at the forefront of maybe dual mandate investing, right, which would include impact as part of that. They have faced a lot, actually, maybe anecdotally, sometimes when you go to visit the offices of especially the university endowments, they can be quite difficult to find because they don't want to signpost them, because they get so many protests from their students for wanting to hear, because students obviously will get very engaged in this and they can see exactly what their university's endowment owns. So I would say one of the earlier trends was they stopped, many of them have stopped investing in, say, fossil fuels. I shouldn't say many, some have stopped. And so that was maybe like a bigger earlier trend, but I think those plus endowments that are oriented to say, like if you're an institution that's trying to do good, you have an endowment, why would you perpetuate problems that you're trying to fix with your endowment? So, I think it's just very synergistic to what they're doing.
I think you highlighted a very interesting trend, because what we observe is that the younger generation is a lot more vocal about some of these values, right? They want to, for example, this topic of climate change is something that creates a lot of strong views among the younger population, and they're also looking for a society that is going to be better in all aspects in terms of providing equal opportunities across different people with different background. So I think if you look at the trend, this is going to persist because it's a grassroots movement. It's not going to be just like 2% sitting in a room and deciding on what's going to happen next.
Adding on that, I think definitely we see that most of the allocations to impact in the US come from endowment and foundations, and there it's really the part that's driving the market there, versus in Europe and Netherlands, a lot of pension funds as well, so a bit more from the institutional side. And exactly as you said, it's really interesting to see that how complementary it is what they're doing with programmatic activities versus their endowment. And that's something that we're still waiting to happen also in Europe. And there are organizations, actually we're working with the EVPA, European Venture Philanthropy Association, that are really trying to push to have foundations to do more on that front, and trying to have them think you are fixing problems with the programmatic side interventions, but on the endowment side, you're still investing in whatever, really not even putting exclusions at times. So that's definitely something that we are expecting to see some change on, and the US are really advanced in that.
Excellent question. Thank you, Alberto-san. This is relating the topic that I came up with sort of new questions to Xiaomin-san. Now that Singapore is becoming a hub of impact investing in Asia, not in China, not in Tokyo. And what do you see the reason behind it? I know the Temasek is now very, very engaged in impact investing. What's the sort of rationale behind why the Singapore government or Singapore sovereign fund is so keen on impact investing?
Well, I cannot speak on behalf of them, but I mean, if you look at sovereign wealth funds, they are really custodians of capital across generations. So they need to think with a much longer term perspective. And when you think about these, say 50, 100-year perspective, these issues of climate change, providing equal opportunities, having good social mobility across the population, these are critical factors versus if you take a 3-month view on your portfolio. So I think for sovereign wealth funds, they do have the ability and the desire to make life better in the long term. And I think in Singapore, we also have very, I would say, proactive regulators, including the MAS, that have rolled out a series of initiatives to promote Singapore as an impact investing hub. We've also seen some financial institutions jump onto the bandwagon. They started to offer, for example, loans that are pegged to, say, impact performance or ESG performance. And for example, if companies were to meet certain criteria, they can get a discount on the spreads that the bank charges for loans. So I think there's an entire ecosystem that is gradually being built to support these activities in Singapore. And I think we also see more impact funds, definitely. Yeah.
Interesting. In Japan, we as an initiative trying to approach GPIF, it's the largest pension fund in Japan, but they said in their ESG report, we do ESG investing, but we don't do impact investing because this is against the fiduciary duty. So so that's why I was kind of interested in why that Singapore is gearing towards impact, not only just in ESG investing. So my last question is that sort of changing the topic again. One thing that is distinguished ESG investing from impact investing seems to be the additionality or invested contribution argument. What is your view on this additionality investment contribution, and why it is important? And also how you can prove that you're, as an investor, putting or providing investor contribution or additionality to the portfolio company. And yeah, amongst the investors in Japan, they seem to be more interested in this topic. So if I can get your view on that, that would be great.
Look, the additionality as an investor, the contribution is immense. It's huge. Every time we make an investment, I mean, for ourselves being a private equity growth in Africa, it is very clear, it's very concrete. Every time we do an investment, we not only do the right due diligence on ESG matters, which doesn't mean that the company is perfect, but more importantly, we can implement the corrective actions of all the gaps that company will have. So very clear, we have an improvement measurement of the things that are not well done and the things after our investment period. And that's very concrete, from gender equality to labor aspects to environmental issues on climate mitigation things. So these very concrete aspects that we can do. In fact, every time we invest in a company, in the shareholders agreement or a sales and purchase agreement, we'll have a clause which imposes to the company that we invest to have a number of measurement systems put in place, as well as active actions put in place that reports to the board to ensure that there is a clear improvement on all of those measurements. So the additionality of us as an investor in the portfolio, it is huge. And not only that, I will say that brings additional value to the portfolio company. Because, as I said, not only the company is in a better place to be on an IPO environment, but also to be acquired by a strategic buyer that will look at that, but also to make sure that all of these additional elements that you bring, that sometimes for many entrepreneurs or for many shareholders, they see very little positive on their valuations of the company. Whenever we end up implementing those, they see a huge valuation and a huge value creation on top of our day-to-day operation, right? So I think it is huge, at least from our perspective, as we're a micro investor. We invest in companies, very concrete companies. It is clearly a huge additionality and a huge contribution. And we explain the stories to our investors by our report, but also by our promotions and explanations of what the impact has been and how the importance of that money it has been. I give you a very clear example. We invested in a hospital group 4 years ago, were 5 doctors. They wanted to build more hospitals, but they didn't have the financial means, and the banks would not follow them. So what we did with these 5 doctors, that they had 5 hospitals, we structured the company into a holdco and an opco. We took the holdco and we put a lot of money inside of people looking at real estate returns, 4, 5, 6, 8, 9%. And then we convinced the doctors that their function was to actually manage the hospitals. Well, without that inflow of additional capital, what happened is that we created 12 new hospitals in 4 years. This is unheard of. You try to create one hospital in Europe, it takes you 10 years. From the moment that you ask for permission to the moment that you finish. In Morocco, in this case, we created 12 hospitals. So what is the impact that this created? Not only delivering more than 50% of the intensive care beds in the Kingdom of Morocco, but now, several weeks ago, you probably heard about the earthquake that happened south of Marrakesh. Well, our hospitals were providing online services and treatment to all those people. Our hospitals were delivering platforms for blood donation that were 10 times more effective than the ones that the government put in place. Our hospitals managed to cure thousands of people that they were treated not only in our hospitals or by distance, or removed to one of our 17 hospitals we have today. So it is very clear that you have a measurable impact, and more importantly, you have a huge additionality and contribution to it. Thank you.
Right, maybe I'll add on. So as impact investors, we want to make a difference and we want to drive change. So I think for me, I think private equity is a very good strategy to do that, because we are trying to drive change. We want to influence management and the operations in a very active way post-investment. So for us, when we look at additionality, it cuts across a few aspects, right? For example, pre-investment, we evaluate and determine how we can add value to the portfolio companies. And this is done ex ante, not ex post, after we have invested, and then we try to backsolve for the impact. So before we invest, we will build an impact thesis. We'll understand what kind of impact that the company is trying to achieve. How can we better support the company in achieving these outcomes? And we are very specific in terms of these KPIs. And just like what Albert mentioned, when we invest, we have investment agreements. We'll write down some of these expectations into our investment agreements. We're very clear in terms of how we plan to value add. For example, we might want to form a specific task force or impact committee to drive certain changes. And there could also be penalties if the companies were to deviate from their initial intended impact pathways. So post-investment, we continue to work very closely with the management to drive these changes, and we'll track these KPIs, and we will communicate this with the company on a regular basis. Just like when we review business and financial performance, we'll review the impact performance. In addition, in order to drive some of this impact, we also have a dedicated technical assistant budget, which we fund out of the partnership. And what we do is we extend this technical assistance budget to help some of our portfolio companies understand the kind of impact and try to deepen the impact that they're creating. So for example, we have edutech company that is based in India. We are now embarking on this exercise with them with the use of our technical assistant budget to understand the learning outcomes of this online learning. And in another example, we have a microfinance company that's based in China. We are partnering a local university and doing a longitudinal study, basically multi-year study of the recipients of microfinance to see how that has helped improve their lives and alleviate them from poverty. So these are concrete examples of how we as impact investors, we work with our portfolio companies to track, measure, and better understand the kind of impact that the portfolio companies are creating. And through that process, we can refine the company's products and services to achieve even better outcomes.
Much for concrete examples. Peterson, please.
In private equity, you are contributing capital, and then you have the opportunity to do what both Albert and Xiaobing have been describing. At DWM, we do the same in our private equity investments. Most of what we do is private credit, though. That's a different kind of engagement. Where is additionality there? Because we rarely have the opportunity. We don't have the opportunity to sit on the board or look over the shoulder of management in the same way as in private equity. So the key to additionality is making sure that our loan, our private credit, is going to enable more of what is already an ongoing impactful engagement. In a financial institution, that's easy to discern. You see what the activities are that they currently finance. If we want our funding to finance those same types of activities, they get to do more of it. That's additionality. We demand reporting, we demand measurement, but the additionality comes from adding more of what they're already doing.
So at T. Rowe, our funds are fundamentally different than your three because we're not private equity investors. So we're not going to have the same, we're not going to have a board seat. We're not going to have the same kind of level of pull that you might have to change things. But in the case of, say, our fixed income funds, we are a primary investor. So we're giving capital to an institution to carry out an impact activity. And, like Peter, we're able to influence how, those bonds are, how the companies are reporting on those bonds, on the impact that's being delivered, and also where they're directing that. And the way that we can influence that is through our discussions with the management, but also our decision to participate or not participate in those particular bonds. And while we might not be able to leverage, the exact same kind of influence, because we won't have a board seat when we're dealing with a bigger entity, the amount of impact that can come and the scale of it is much bigger with our investments, right? Because, and then if we look on the equity side, I think it's very similar in that in this case, we're not actually a primary investor in most cases. Occasionally we might be an IPO investor, but that wouldn't be the norm. However, we are able to influence these companies and be good shareholders to the company and deploy effective stewardship programs to be able to manage the operation. So, one of the examples that we gave on our slides is a company called Tomra Systems. So Tomra Systems is, they do reverse vending machines. So it's a listed public equity. So after we're finished with our bottles, we could put them into Tomra Systems. They'll collect it, recycle all of that plastic so it can be reused. So fundamentally a good thing to do. As equity investors, we help their valuation and we help that company be able to access more debt and grow and be able to sell more reverse vending machines so that more plastic can be collected. Now, this is a pretty good company that's got great reporting, very great objectives, but one of the risks that we've identified is around microplastics. So while Tomra is out collecting macroplastics like this that we don't want to have floating around, when they collect it, it pulls off more microplastics through the whole recycling. So that's a topic that we discuss with them in terms of risk mitigation and what are the safest, most effective ways to do that. So I think that's just one example of how we can bring additionality. But I will say it is different than if you're a private investor.
Thank you very much. Yes.
I think it's been great to hear all the different approaches to the investor contribution, and indeed it's very different for asset classes. I think what we have seen, and the impact management project has quite some helpful resources on that. They classify investor contribution to be from signaling that impact matters, to actively engaging, to grow undersupplied markets, and then finally providing flexible capital, which is usually something that more the catalytic and philanthropic part of the spectrum. And signaling that impact matters, I think it's a bit more towards the voting and stewardship practices, a bit less on the impact investing side. But exactly what we heard about growing undersupplied markets and engaging actively with the underlying companies. That's exactly what you can do as an impact investor. And also what really helps at times is mapping down what you are doing, creating a fund theory of change at the fund level, really. So that brings you to really list what are the activities that the fund does and what are the outputs of that, and then how do you reach from there the outcomes and the impacts that you are targeting. So we see that as a helpful exercise through which you can then list what are really the investors' activities and contribution towards the.
Thank you very much. Yes, it's been interesting to hear from different practice, different asset class, and different regions. So now I'd like to open to the floor. We have plenty of time, like around 30 minutes. So if any questions from the floor, I'd like to, yes. ちょっとマイクがあるかな。Thank you.
Hello, my name's Craig and I'm from Australia. Can I go back to something early on in the conversation about I think it was the US conversation and ESG and finding its way into the courts. I forget who made the point about challenging risk in the courts. So Australia had a very interesting situation, I think it was 5 years ago, where a superannuation fund called REST, one of the larger funds in the country, $70 or $80 billion, was taken to court by an individual member for not considering climate risk in the portfolio. And within 12 to 18 months, we saw a huge change in the superannuation industry. And it's fair to say that today, most, if not all, superannuation funds have that as a top priority. And therefore, not surprising if you look at your delegate list to see so many Australians at the PRI event. So I suppose my question to the panel is, in the same way that we've seen the EU taxonomy move in different countries, this kind of one country moving across. Just intrigued to hear kind of US, Europe, Asia, where you see that climate mitigation risk heading to the courts. Or rather, over what time frame, I suppose would be a better way of phrasing the question in those different regions.
I guess I'm the one who brought up this prospect that the issue will be resolved in the U.S. in the courts. That's my personal opinion. I think it will. I can't wait for it to happen. But to your point, earlier this week in Sydney, last week, pardon me, I met with Rest and found the case that you're referring to fascinating because it's exactly what I'm talking about. I think that will happen in the U.S. Now, every Australian super fund has reacted by ostensibly paying attention to ESG type risks, but find me one Australian super fund that has yet to invest in impact. I'm asking you to find me one because I'd like to go meet them, please. I need to know who they are.
From the European perspective, I think it's very different. I think the governments are the one that are pushing the climate change agenda. You will have the biggest investors on climate change is actually the government's funds. You could see, in fact, today, one of the amazing things is that governments are looking for projects for our climate change adaptation and climate change mitigation big time. As all of them will happen, if you guys know, after the latest meetings that they had, every single country came with a commitment of investing in climate change. But now the issue that they have is actually, what do they do with the money? So there's like a huge amount of money allocated to climate change that drives that. When that will become part of the public, of the private capital, that's the question, right? When you look at Article 8 or Article 9, actually it's a start of regulating and putting a framework to make sure that investors, they actually deliver what they promise through a regulated entity. So I think it's already there. I think, and I don't see that happening. You know, I think court cases in Europe are less activist driven, I guess, than in many other Australia and the US. But I don't think it's needed because it's really embedded into the capital markets. I will see from the Europe perspective. I don't know if you think the same, Sharon, but I think Sharon.
Yeah, I would say I agree with what you mentioned, and the SFDR is already including some of the integration with the baseline Article 6, already performing certain risk assessments. So yeah, I've heard actually of funds, of an impact fund that was actually focused on climate litigations, which is something that probably, yes, will happen more, but with the support from regulation, I think that it will be probably less impactful or less politicized as well in Europe.
I think there's another angle on litigation that's worth mentioning, and that would be the litigation against governments and companies, because we are seeing a lot more of that. I guess there's just been a court case launched by some young Portuguese students in the European courts, suing them for not being tough enough on regulation and moving fast enough. The United Kingdom also has a legally binding net zero target. They are getting periodically sued by groups for not, implementing fast enough. And then another thing that we look at quite actively is the litigation that we see against corporates. So it's been most significant against the oil and gas sector for basically muddying the waters on climate change and the facts around climate change. And we think that is actually really interesting. So to date, the litigation hasn't been successful, but it is sort of a death by 1,000 paper cuts approach that the litigators are taking, in that, they I guess maybe it's like terrorists. They, the company has to be on the ball all the time, whereas, they just need to win once, and get that kind of killer fact. I think maybe one of the really interesting ones recently was from Client Earth. And Client Earth is an organization that was started by an American lawyer who married an Englishman, and so moved to the UK, and he had been quite a famous climate activist and won a lot of big cases in the United States. And he's now trying to set up the same sort of culture in Europe. And they had one recently where they lost, but I think they have some grounds to move forward. But they were going in and suing as a shareholder of Shell, the company or the board of directors. So they were trying to get themselves into a position where Shell would actually have to pay for its own lawsuit against itself. They weren't successful, but they apparently came up with some point. So I think we probably will see a lot more of this coming in
Thank you very much for the question. Any other question? ちょっとお待ちください、マイクが。
Thank you very much for your discussion and very interesting insights. I learned a lot. My name is Satoko. We run a small social impact investing initiative in Japan, and we invest into companies, small companies, startups in Asia. I have two questions. First one is in recent development or development of interest towards biodiversity. I think there are growing interest among investors and companies in Japan too. And there's potential debate or complexity into this environmental issue. And so how does it influence into your investment theory, or how do you tackle this issue? Particularly, we are interested in this biodiversity. They mentioned about influence to the indigenous people, local communities, which will bring into a lot more complexity in KPIs and discussions, I assume. So how do you see this, and how do you influence to your investment policy? That's one. Second one is maybe more into Europe. There is a tradition of social economy, social finance, and solidarity finance. And recently in UN, like ILO, they mention about social and solidarity economy. And there is a discussion on that. I think to date, this ESG impact investing and social solidarity economy has like a different streamline, or maybe the origin of the philosophy is different. But then there is some movement to merge or to discuss together from ESG investors' point of view. Do you see any relevance or interest from you? I just want to see how do you view on this. Thank you.
Yeah, so maybe if I'm going to start, I think the investment policy on climate, I think is fundamental to your impact investment, strategy. In our funds, I'm sure that the same as many of my colleagues here, we set up investment policies. One of them being climate change and climate change mitigation and adaptability. I must say that the climate change mitigation, it is a much easier investment strategy to put in place than the adaptability, because adaptability means changing your strategy of your firm, where mitigation is doing concrete investment cases that helps to reduce CO2 emissions, They use more renewable energies. And I can give you many examples of that. For example, we have a supermarket chain in Tunisia that we started with 100 shops. Today, we created 500 shops, 500 supermarkets, which we bring affordable food to C-class citizens in Tunisia, very relevant at this moment of time. And also we implemented a system of managing the energy across the 500 supermarkets from a centralized point of view, which reduces the uses of energy by more than 30%, as a very clear example. As actually in this same example, I recall now that we also have an implementation of more than 160 of those shops that now have full usage of renewable energy by putting solar panels on the ceilings of the supermarkets. And now those supermarkets is 150, 160. They use 100% of renewable energy. So it's you can have a very concrete investment policies on climate change adaptation and mitigation in all your investments, and very concretely. Now, to answer your question before I let my colleagues also look, we see solidarity finance by what we call it financial inclusion. I think financial inclusion in developing world is a much impactful way to be able to give access to proper financing to the higher population. We invested in a company in Sub-Saharan Africa, which was based in Ivory Coast, Senegal, Burkina Faso, Niger, Mali, Congo Brazzaville, Cameroon, Togo, and Ghana. And what we were doing is through microcredits, licenses, we were providing financing of microfinance to entrepreneurs, as well as to woman-owned companies. The company was called Cofina, and we managed to have more than 400,000 SMEs, and we managed to serve more than 52 million Africans to be able to do that. So more than solidarity by finance, we see it as financial inclusion, providing the citizens, mainly the C-class citizens, which are the poorest of all, to be able to have financing for their businesses and for their needs. That also linked to remittance business, which the both of them are hand in hand. So that would be two examples of this solidarity finance that we have provided. Thank you.
Yeah, I think just to add that biodiversity, I think it's definitely something that we see more and more interest in, also from investors, pension funds in the Netherlands. Governments are looking at it, so definitely something that will come. They say it's the next wave of the climate change, and the difficulty right now is really measuring it. So trying to find that one measure, the comparable of the CO2, what can you have in terms of biodiversity. And I think recently I saw that they came up with the task for nature related financial disclosures, so probably something that will support with more standard disclosures from that point of view. So yeah, we are definitely looking at it, but currently in terms of funds that really have a clear contribution specifically on biodiversity, it's still quite limited because also of this measurement challenge. On the social side, yes, it's a bit less defined as compared to the environmental strategies and impact investing. And at the beginning, probably you've seen that all of the targets that we see also in terms of SDGs, the environmental ones are the ones receiving most allocations compared to the social ones. And I think also it's underlying assets, again, a bit making the difference there in terms of environmental solutions. They need to reach broad scale and you can scale them up globally, while on the social side you need more penetration and trying to get to the solutions to the most underserved. Also the EU and the social taxonomy is still coming up, so there I think also catching up a little bit in that point.
I agree with this observation on the measurement part on biodiversity. It is really difficult. I think on our end at ABC, we also back companies that try to solve the biodiversity challenges, largely in the sustainable food and agriculture space. So for example, we've invested in alternative proteins, and one of our companies is actually in the breeding of black soldier flies. And I think the objective of that is to extract insect proteins and insect oil. And if you look at the whole macro backdrop towards this theme, it's really about we're going to have 10 billion global population by 2050. And also rising affluence in many parts of emerging markets. And there's a strong correlation between the consumption of animal proteins with rising affluence. And it's not a linear correlation, it's an exponential correlation. So we're talking about going to massively increase the amount of animal proteins that the world needs. With that theme in mind, we've invested, for example, this insect protein company. And one of the most efficient ways to produce animal proteins for large number of people is actually aquaculture. However, the bottleneck to this aquaculture industry is actually in the animal feed space, because they are basically given like Peruvian anchovies, right? And we are going to deplete the ocean resource just with all this explosion in the aquaculture industry. So insect proteins and insect oil have the unique, I would say, nutritional characteristic that can displace small fish in the whole aquaculture industry, hence driving biodiversity protection. And another of our investment is actually in the plant-based meat sector. Again, I mean, if you think about, if everyone were to consume beef, just like in many of the developed markets, we're going to need more than one Earth to be able to sustain the breeding of cows. And hence, there's a need for alternative source of proteins. And by making plant-based proteins to be as delicious as beef, such that it's aspirational, we hope to encourage at least some of the population to adopt a different diet.
I can add something quickly. So at TIRA, we're supporters of the TNFD, and we also are on the investor advisory group for the ISSB, so the International Sustainability Standards Board. So it's expected that the ISSB will start to layer in biodiversity metrics, and hopefully they're similar to what we've seen in the TNFD's first disclosure. From our standpoint, we are more focused on companies that we think have a bigger biodiversity impact to try and get them to report more information on this. But it hasn't been very standardized because the TNFD just came out earlier this year. Maybe I'll give one example of a bond that we purchased that addressed both biodiversity and social solidarity. So we purchased what was called the Rhino Bond, issued by the World Bank, and it was funding to protect 2 parks in Africa, and really focused on protecting the black rhino. And the reason why the black rhino is very important is because it's a keystone species. So its presence promotes the life of lots more biodiversity. It does things like it creates puddles and watering holes for other animals, and lots lives inside of its, we won't go into the details of all the species that it promotes. But with that investment, it also was investing in the local community by creating more jobs, because they were adding more park rangers, and also creating more educational opportunities for that local community, and really understanding that you need to economically support the people living around the black rhinos in order to protect them as well.
Very interesting, black rhino. Maybe.
Hi, good afternoon, and thank you for a fascinating session. My name is Tongai. I'm typically based in London. My question was around the European Commission's regulations. So one of the things I think the European Commission has said themselves is there have been unintended consequences of SFDR, for example, where they intended it to be a disclosure regime, and it's ultimately turned out to be a labeling regime, where it feels that's the way the industry has gone. They are in the middle of a targeted consultation and public consultation. What do the panelists expect of this? And in parallel with that, we've also seen the UK come out with its own sort of proposals. Would be very interested in anything panelists can add. Thank you.
I think I touched upon it quickly before. I hope that they will consider the use that's been done so far as a labeling system, and therefore make clearer categorization of the articles as well, and minimum criteria to fit within that. So having it evolve also towards a labeling system. However, I feel that before the end of this mandate, so next year at one point we will change the European Commission mandates. I think before that it will be difficult. That will actually something that will change. So consultations will continue, and then they will take on the learnings for the next one, I would expect. And I think it's probably important also to mention that for investors to not wait to have this change happening, or to wait to see how funds will be relabeled, if they will go from 9 to 8. It will still take quite some time, so I don't expect them to come back from this consultation with a clear change about the regulation. I think it's a really fast evolving industry, and we will continue to see change in that. And they're playing a little bit catch up with what is happening.
Maybe one or two more questions. オンラインの方ももしご質問があれば、チャットに入れていただくか、日本語でも構いませんので。There are still like 40 people online ですね。畑さんお願いします。
Thank you for your, presentation discussion today. So my question is, I think I have two questions. The first is about the relationship between financial performance and environmental social issues, social outcomes. So in Japan, still, impact investors have headache, I would say. It's really hard to prove there's a positive correlation between, financial performance and the social impact. And some still say impact can be like leading indicator for financial performance because, that kind of potential market size or depth can be captured only through the impact brands, and it's sometimes hard to capture through the financial due diligence. But if you have found some, correlation or, the kind of evidence through your, practices in impact space so far, I would be really appreciate, to learn that. That's my first question. And second question is a totally different topic, but about measurement of impact. So there are some initiative about, monetizing impact, such as value balancing alliance or impact weighted accounts. So they try to convert quantified impact to monetary, kind of value. And I know it's really hard to convert into monetary currency, but how do you see that kind of initiative? Would you apply one of those initiatives in the near future, or at this point you will continue to using the, I would say, conventional framework such as like IFSI or something like that? Thank you.
Yes. If I may try to answer the first one, easier than the second one. Look, there is a strong correlation, at least in developing markets, which probably is easier to make that correlation between financial returns and impact returns. For us, very clearly, when we invest in a company or we do a good job of implementing the corrective actions to make sure that at the end of our tenure in the company has the proper social, policies, equal pay policies, vacation pay policies, and so on and so forth on the social aspects of the company. When that company has created a number of new jobs over the last 5 years, we created overall in our portfolio around 10,000 new jobs directly, direct jobs for our portfolio. When we look at the mitigation action that we have put in place to make sure that water waste, waste management of special, scrap from manufacturing, and so on and so forth, we see that has a much bigger value, the company as such, when we create a liquidity event. Because for us, it is very clear. It's like we invest in a company, after 4, 5, 6 years, we exit. And that moment of exit, that's when we create the value for our investors. Now, at the beginning, when we started about 15 years ago, ESG was not as present and as important for us. And we can see that the value that we create in the company, because of the aspects we were missing, it had a lower valuation. And that specifically, it's important for 2 types. Actually, no, for the 3 types of liquidity events, being the IPO. When you go and you take the IPO, because it's a regulatory market, you're imposed to do a number of things. So investors and institutional investors will also take into account those ESG matters that you have implemented. It's also important for the strategic buyer. I remember we had one Japanese strategic buyer for one of our logistics companies that was operating across North Africa. And they look very strongly about those ESG measurements that we put in place. Not as much as because we had created impact, but as much as because that will definitely mitigate the risk that they were thinking about when investing in developing in an emerging market. So it is a very clear correlation between financial returns and impact measurements or ESG implementations. That's on your first question, and we can demonstrate that financially. We can see in this company we have our, we call it the corrective actions plans. When we implemented 100%, it has a value that we only implemented 80%. Sometimes it happens that you can only implement 80% because it's more complicated, it requires more time, and so on and so forth. Now, your second question, this is a very challenging question because it's true. How do we monetize the impact that we have created? How do we look? The only one that we have managed to show is CO2 emissions. CO2 emission has a value in the market, and that is the way that we can measure it. We measure it. It is not easy to measure. We need to have a special consultancy firms that they do that measurement for us. So it's almost a third-party evaluation. But it's also true that we haven't found, at least ourselves, so I don't know if any of my colleagues, to find a way to monetize that impact. We're monetizing because we create a liquidity event. And that liquidity event will give us 30% or 40% or 20% IRR. We know that it is monetized because the quality of the asset, it is much higher, right? But which part is the financial performance and which part is the impact? That's something that we have not been able to quantify, identify. I don't know if my colleagues can help us here.
I agree with the first thing you said, Albert, that in the developing world, it is certainly our experience as well, that impact does correlate with better performance. I think it depends how you demonstrate that depends on the data that you develop in any particular investment strategy. Ours is investing in, or let's say specifically lending to financial institutions in developing countries. They have their assets that have certain characteristics. Those characteristics include that the purpose of the loan is productive. It enables their client to generate an income. That's impactful. it also reduces risk because those clients who are generating income are more readily able to repay their loans. Inclusive finance. It's an easy area in which to make the case that you're looking for. I'll give you broad statistics. We've made over 1,000 loans, private credits, $5 million average size to financial institutions in the developing world over 15, 16, 17 years, whatever. We have lost money 13 times out of over 1,000. You can translate that to what is our average annual credit loss rate, and it's a little over 35 basis points. And we're lending to countries like Bolivia, Cambodia, Zambia. We are talking about frontier markets and emerging markets. I challenge you to find any type of credit activity in those countries that would generate such few losses if it isn't impactful. So I think that makes the case.
I'll offer my views as well. When we look at financial performance, I think we also have to be quite specific in terms of what we are looking for. Are we looking for returns, or are we looking at the risk? Because both are financial performance, and also what's the time frame. And if you look at a longer term time frame, like private equity, 5 years, we do see that the impact portfolio, because it's really providing essential services to underserved segments of the population on the social side. There's huge underpenetration, and essential services are things like electricity, healthcare. These are not things that discretionary in the event of a recession, people just stop spending on that. So we do see a very resilient portfolio that's built around the social impact thematics of our portfolio. And then on the environmental aspect of the portfolio, the question then is, has businesses been fully, I would say, accounting for the cost of externalities? I believe not in today's context, because no one's paying for carbon in many countries. No one's paying for the loss of biodiversity. If you believe that that's going to be a long-term trend, by positioning for impact on the environmental side, you are actually positioning your portfolio in advance of changes which are coming. I do not know when that's going to be. It could be 3 years, it could be 5 years. And I think to an earlier question on, for example, why is it that some of our investors, like sovereign wealth funds, are able to invest in impact? They have imputed a cost of carbon in terms of that investment. And when they look at it, it makes sense. So there could be different perspective, even when you look at financial performance.
Thank you very much. Do you want to speak a bit, or?
From our perspective, in the listed space, so for our funds, say our global impact equity fund is not going to have a different alpha target or materially different tracking error than our mainstream global equity fund. We don't have a long track record yet, so well, the fund's done well. Like I don't want to overstate. And I think that if you look in the listed space overall to look at long-term track record, and I don't, maybe Kara, you have some stats on this. It tends to be a very muddled investment universe, so it's quite difficult to identify funds that are doing the exact same thing, right? So you might be looking at funds that have a sustainable lens versus an impact lens. So I don't have an exact answer for you there on the track record.
Yes, exactly. It's quite difficult for us. We would love to have performance data on the database as well, but unfortunately it's been quite hard. We have the data from listed markets, but even there, very different benchmarks, sometimes no benchmark that they're tracking, different thematic focus. So it's quite hard to really compare that. And yeah, on the metrics, I would say we are seeing the GINS Iris Plus being used more and more. It's also aligning with the IMP framework and also with the framework from the impact principles, the OPIM. So we see quite a convergence towards that front, more than the impact, the multiples usage. Yeah. So
Thank you very much. Sorry, I think we actually run over the 5 minutes. Then, thank you very much for the discussion and also great questions from the floor. I really appreciate your participation in that. We are having some reception after this. There are some drinks and snacks are ready over there, and actually the cost of the reception was provided by Developing World Market. ピーターさん、Thank you very much. 本日はこれにて終了いたしますが、1時間ほどですね、軽食を用意しておりますので、よろしければ、残って名刺交換等のお時間でお使いくださいませ。オンラインの方も本当にありがとうございました。では、今日はこれで終わりにさせていただきたいと思います。どうもありがとうございました。